Hey, welcome back to our channel, and in this video we are going to talk about a common question. Should I take a fixed rate mortgage or in a variable or adjustable rate mortgage? It's a very common question. Now, a fixed rate mortgage, what that means is your payment amount and your rate actually doesn't change throughout the term. For example, you may obtain a 3-year fixed mortgage at 4.5%. That means for 3 years, your rate is 4.5%, and whatever your payment is based on a 4.5% interest rate is your payment. It will not change over a 3-year period. After the 3-year period is over, you have the ability to renew with that lender or potentially switch lenders and go into another fixed rate term or potentially a variable or an adjustable rate term. And what a variable or adjustable rate mortgage is pretty much your interest rate changes with the Bank of Canada prime rate. Now, there is confusion about variable and adjustable rate mortgages, so I do want to clarify that. An adjustable rate mortgage is where your payment actually goes up or down if the Bank of Canada moves their rate up or down. And a lender in this category is Scotiabank. So your payment adjusts if the Bank of Canada cuts rates or increases rates. Now, if you are in a variable rate mortgage, this is where your payment does not change. For example, let's just say a day of signing, mortgage documents are done, your mortgage has funded, and your payment is $2,000 a month in a variable rate mortgage. Now the Bank of Canada continues to cut rates. Your $2,000 a month payment will not change. However, more of your payment goes towards principal if rates go down, less goes towards interest. But if rates go up, more of your money or your payment amount goes towards interest and less towards principal. A lender in this category is TD Canada Trust. Now, over the past 2 years, we've seen huge rate cuts, a lot of rate cuts by the Bank of Canada because the Bank of Canada was trying to tackle inflation. We were trying to get inflation down to the 2% target level. And over the years, many people got very scared of going with a variable rate mortgage or an adjustable rate mortgage just because there was no certainty. No one knew how long this will last. No one knew how long the rate hike cycle will last. How long will the Bank of Canada keep increasing rates? And people were scared about that because a lot of individuals, when they get a home, it's a big investment. It's a big purchase. Depending on where you live, in the lower mainland, it's a high purchase price, which means a high mortgage amount, which means a high mortgage payment. So a lot of individuals wanted that certainty, that they wanted to know what their mortgage payment is per month. So for that reason, many people chose a fixed rate mortgage just so they could sleep well at night knowing what their payment is. And going forward, also a lot of people chose a fixed rate mortgage just because it was lower than a variable or an adjustable rate mortgage. And a lower rate means you will qualify for a higher mortgage amount because your stress test is lower. So many people chose a fixed rate mortgage because there was certainty as well as they could qualify for more mortgage money, which allows them to potentially, receive an extra $25, $50, or $75,000 in mortgage money and go up in purchase price as well. Now things have changed. The Bank of Canada needs to stimulate the economy. And when the economy needs to be stimulated, the Bank of Canada starts cutting interest rates. Also, we are sitting at below 2% for inflation. Our target was 2%, but now we're panicking. We're sitting at below 2%. Our economy is struggling as well. And that being said, we are expecting several rate cuts through 2025. And this means this is a big relief for an adjustable rate mortgage or a variable rate mortgage because you're paying less interest or your payments are going down. July of 2023, our prime rate was sitting at 7.2%, and today, almost a year and a half later, we're sitting at 5.95%. It's a big reduction, and future cuts are still on their way. And this is a big relief because if you are an adjustable rate mortgage where your payment actually goes down as the Bank of Canada cuts rates, you're seeing big savings. And you're seeing every time the Bank of Canada cuts rates, you're seeing a quarter point decrease. That means you're saving about $15 a month for every $100,000 that you owe. So now we've seen a total of 1.25% in rate cuts because we had a jumbo rate cut of 50 basis points. So if you do the math, you're sitting at $75 a month reduction for every $100,000 that you owe. And if you have $1 million mortgage, that could be $750 a month, which is a lot of money. That could go towards a grocery bill, That could go towards your property taxes. So the savings are there, and we are expecting more savings going forward. As I said, the Bank of Canada is projecting several rate cuts, and we may even see a jumbo rate cut in December again of 50 basis points. Right now, the estimated difference between a fixed rate mortgage and an adjustable rate mortgage or a variable rate mortgage is about 1%. So it isn't a massive difference. It was a bigger difference before, but it's still a 1% difference. And this is why many people are now thinking, should I take an adjustable rate mortgage or a variable rate mortgage? Because we're seeing several rate cuts come, especially if we see a 50 basis point rate cut in December. And if that does happen, the gap actually, goes smaller and smaller. So that being said, many people are looking at, maybe it's a good time to go variable and adjustable rate mortgage now, because if I take it now, by the mid of 2025, my rate in a variable and adjustable may be lower than a fixed rate mortgage. Now, the thing with going in that direction is you got to look at nothing's guaranteed going forward. Things could change. We have to look at employment reports, inflation report, for example. Let's just say inflation starts to go back up again. This will cause or may cause the Bank of Canada to pause the rate cutting cycle. They may remain steady for a short period of time or a long period of time. Nothing is ever guaranteed. And we've seen that over the last 2 years where the Bank of Canada stated that rates will stay low for a very long time. And we had massive rate increases and things changed for many households across Canada. And it was sad to see. Things got very tight. So if you are someone that is risk adverse, won't sleep at night, and you'll be panicked about every single rate announcement, there's nothing wrong with that, and you want security, it may be better to go with the fixed rate mortgage. However, if you are an individual that is more open to risk, maybe you have a higher budget, maybe when you purchase a property, potentially rates could go back up again, and your mortgage payment may go up $100, $200, $300 a month, but you have room for that, and you're open to potentially seeing what the Bank of Canada does, and you're confident that our economy is struggling, we need more rate cuts, then you might want to go variable or an adjustable rate mortgage. So it depends on a lot of different factors. It also depends on which lender you're proceeding with, because every lender has a different product and penalties. Those are key. Many people are potentially getting trapped by a certain lender where they're obtaining a 3-year fix because they're getting maybe a great rate, and that's all they're looking at. What they don't know is internally posted rates are actually getting cut, and their penalty to break the mortgage is getting bigger and bigger and bigger. And when rates go down in the near future, they actually won't be able to leave that lender because their penalty will be too high. And they're going to be stuck paying a high interest rate. So the product really matters. Another common question we had was, can we go variable now and lock in potentially next summer, mid 2025, when rates most likely will be lower, fixed rates even? And yes, you can, depending on the lender. There's one lender that will allow you to lock into a 3-year fixed as of day one, which is an excellent product. And then there's another lender where other lenders where they only allow you to lock in to a term that's greater or equal than the term remaining. So next year you may have to lock into a 4-year fixed, and that's quite risky because a 4 and a 5-year fixed is quite a long time to be locked into. If you want to make a change and you have to break your mortgage, you may pay a massive penalty. That's why we always advise or consult our clients. A short-term fixed mortgage may be a better option than sometimes going with a 4 or a 5-year fixed mortgage. At the end of the day, you need to run a cost analysis. Run a cost analysis to see, if you get a fixed rate today and a variable rate today and potential rate cuts, how much interest are you paying and saving? How much are you really spending on what if scenarios? It doesn't hurt to run that. Nothing's ever guaranteed, but at least you have some sort of idea of what your break-even point is or where rates have to go in order for you to start saving in a variable or an adjustable rate mortgage versus a fixed rate mortgage. So you always have to run the numbers, and there are many different scenarios you could run. I hope this video was helpful. I hope this video gave you some tips and insight on variable and fixed rate mortgages and kind of gave you a direction on where to proceed potentially and maybe what not to go with. Maybe you're thinking about variable before and now you got educated about, Bank of Canada, how it impacts mortgage rates, and also even a home equity line of credit rate or an unsecured line of credit rate, and you're potentially feeling better about going with a 3-year fixed. That's okay, but just choose it with the right lender, because then you have a good exit strategy. And even the other way around, maybe you thought a fixed rate mortgage was, some other type of product, and you like the flexibility of a variable because, You do have more flexibility in the variable in the sense of penalties. Typically, the penalty to break a mortgage in a variable rate mortgage or adjustable rate mortgage is 3 months interest. So the penalty to get out is smaller. So this is where you got to run all these cost analysis and scenarios. But I hope this video was helpful, and see you at our next video. And don't forget to subscribe to our channel, like, comment, and share.